Panic selling refers to a situation where investors offload their stocks or other assets en masse due to fear of further losses, often triggered by a sudden market downturn, negative news, or economic uncertainty. This emotional reaction leads to a rapid decline in stock prices, often below their intrinsic value. Key characteristics of panic selling. 1. Emotional decision-making. Investors act out of fear, ignoring fundamentals. 2. High volatility, sharp price drops in a short period. 3. Mass participation. Large numbers of retail investors exit the market simultaneously. 4. Liquidity crunch. Lower prices due to excessive supply of assets. Who benefits the most from panic selling? 1. Institutional investors, FIIs, DIIs, hedge funds. Buying opportunities. Institutions with large capital can buy quality stocks at heavily discounted prices. They take advantage of panic-induced undervaluation to accumulate shares. Contrarian strategies. While retail investors sell in fear, institutional investors often enter the market, stabilizing it and profiting when prices recover. 2. Long-term value. Investors' discounted assets. Investors like Warren Buffett or value-oriented funds see panic selling as an opportunity to buy fundamentally strong stocks at a bargain. Market mispricing. Panic creates scenarios where even blue-chip stocks trade below their fair value. 3. Short sellers. Profiting from declines, short sellers benefit by betting against stocks and making profits as prices plummet during panic selling. Amplification. Their activities can sometimes exacerbate panic selling, further driving down prices. 4. Market makers, wider spreads. During high volatility, market makers benefit from increased trading volume and wider bid-ask spreads. 5. Cash-rich investors, flexibility. Investors with liquid capital can deploy funds during such dips, capturing significant upside potential when the market recovers. Who loses the most? Retail investors. They often sell at the worst possible time, locking in losses. Fear and lack of strategy cause them to exit markets prematurely. Over-leveraged traders. Traders using borrowed funds face margin calls, forcing them to sell at steep losses. How to avoid losses during panic selling. 1. Stay rational. Avoid emotional decisions. Focus on fundamentals. 2. Diversify. Spread risk across sectors and asset classes. 3. Emergency funds. Keep liquid funds to avoid selling assets at a loss. 4. Long-term perspective. Remember that markets generally recover over time. 5. Use stop losses. Protect against steep declines by setting predefined exit points. Conclusion: panic selling disproportionately benefits institutional investors, value buyers, and short sellers, while retail investors and over-leveraged traders typically bear the brunt. Staying calm, informed, and prepared can help investors navigate such situations effectively.